Hello, and welcome to Wealth is Possible, the show where we talk about personal finance and building wealth. We are your hosts, Vino, Vince, and Evan. We'll be discussing various methods of building wealth and growing your cash flow, including the stock market, real estate, cryptocurrency, and various business ventures.
Thank you guys for tuning in to another episode of Wealth is Possible. On today's show, we're talking about tax tips on starting and operating a business and tax tips on buying and selling real estate with Terrence Kumar, who's a CPA and partner at Grandview Realty. Thanks for being on.
Thanks for having me, guys. I've been seeing the reels being posted and whatnot, didn't expect to be here so quickly.
Now, we're super happy to have you on.
100%.
I'm sure our viewers are going to learn a lot about your field and
Yeah, absolutely. I think we'll try to cover the tax implications of buying and selling real estate, of starting and operating a business. When should you incorporate? We'll try to get in and cover as much as possible. Maybe some landlord and tenant board stories as well,
100%,
right?
100%.
So part of the real estate, but
Okay,
we'll
why don't
get
we
into it.
start off by telling us a little bit about your upbringing and the beginning of your story?
Yeah, give us your background.
Yeah.
Let everybody know who you are and shit.
Sure. So my parents, hardworking immigrant parents, they came to the country right away. They started delivering the Toronto Sun when print was a thing back then, and so 364 days a year, no matter rain, snow, van broke down, you're going out and you're delivering the papers, right? So we didn't really know much. My parents leave at around 1 a.m, come by 7:30. We open our eyes and the lunches are ready and we're off to school, right? So that was really the hustle that my parents kind of went through at the beginning to kind of get to the middle class eventually. But that upbringing really taught me because my mom and my dad used to do the delivery together. So one time my mom had a thyroid surgery. I went on the delivery that day, and I was tying the papers, and I see my dad, in the snow, pulling these papers, dropping them off. It's super cold, right? And pretty eye-opening experience a couple times doing that. So I was probably like around 12 at that time, right? And really learned the value of money just off of seeing that and how my parents were working pretty hard. And then fast forward, I went to Mary Ward. It was like a self-directed high school. From there, I went to Laurier and then became a CPA and then a realtor, and we'll get into that. But really just immigrant story.
So Terrence, I'm off camera. You're actually telling us about your whole swimming school that you kind of started off. You want to kind of go into that whole swimming school and how you kind of got started, and what the pros and cons of starting that swimming school was, and how that contributed to who you are right now.
Yeah, so the swim school started once I became a lifeguard swim instructor and was doing that for a couple of years. But originally how that started was I was 12 years old. Doing Ultra One, super late to the swimming game, I guess you could say, or learning how to swim. And it just started off because my aunt was like, we're going to have my cousins were going to be enrolled, and my aunt asked my mom, do you want to put them in swimming? And we were kind of, low income, didn't really know much at that time. My parents were kind of scared of the idea of putting us in water too. So at 12 years old, I was swimming with these 5-year-olds, and the instructors were 16. And I kind of the light bulb went off. I wanted to become a swim instructor for some reason. So fast forward, I did the Ultra 1 to Ultra 9, and then, the bronze program, and became a lifeguard swim instructor by 16. So I kind of I would practice on the weekends, tell my mom to take me to free swim so I could learn the skills I learned that week.
This was your end all be all, right? This is yeah.
Yeah, so eventually when I passed the lifeguard course, I came home, I was so happy, and then that summer interviewed for the city, and by 16 I was teaching at the city. And so that was a pretty, quick learning curve. And obviously I didn't feel like the most amazing swimmer, right? So we practice kind of made perfect there in a sense. And then after working at the city for a few years, I saw, the pool manager. So I tried to obviously apply to be a pool manager. So 2 years into lifeguarding and instructing, I became a pool manager. And that was obviously a new role, new position, kind of first aspect of managing people and managing lifeguards, right? And I think whenever you get into a managerial position, you have a little bit of authority and you want to, exercise that correctly. You have male, female, you have, various age groups, right? So it's kind of the first role where I was kind of managing people, right?
Did they pay you more when you became a pool manager?
They did $2 more an hour. It was, I think, $18 an hour
so
at that point.
At this point, you're up.
I guess you could say on average.
Yeah,
On
at that point,
average,
he was a baller.
For
still.
16, wait, you're
on-
16 or at that time? Or?
No. Now
So
I'm
after.
19.
You're like
Now I'm
19,
19.
yeah.
So two and a half years after, I applied for the role and then I got it. And so I'm 19, first summer now as a pool manager. And remember, like, there's a good age gap too between lifeguards and instructors, right?
Yeah.
Like 16 being like, the new lifeguard, and then even some people lifeguard till they're 25, 26, right? It's still a good university gig, even when you're in university, right?
Yeah.
Working part-time or full-time, or part-time, I should say. So anyways, fast forward, pool managing, I ended up seeing another pool manager was running a swim school, and I was thinking, okay, that's an interesting business to be able to run on the side, right? And so what actually happened was I'm in university at this point. I think it's first year, and I kind of had this idea where I wanted to start my first business by 20, right? And so at that point, I was kind of thinking like, okay, what skills do I have that I could use to start a business with? And
What was it that kind of pushed you to start a business? Was there anything specific that
I
you were
think it
doing?
was just an entrepreneurial instinct. I just felt, I've been an employee now for like 4 or 5 years, and I obviously saw people run businesses. And the main reason why I actually really wanted to start a business was because after my first co-op term with the CRA, so I went to business at Laurier. We'll get into that a little bit later, but I did the co-op program. The first co-op was I was doing HST audits. So I was running audits on people's HST returns, right? So what they were claiming and what they were remitting. And I saw the different types of businesses that were out there. And so that kind of pushed me into, starting a business. And then I thought, what income skill do I have, or high income skill, I guess, nowadays people call it.
Yeah.
At that time, it was a high income skill, and it was in demand. I just thought it was a foolproof, safe business because everybody needed to learn how to swim, right? I thought it was kind of a basic skill. I never really had to sell it. Whenever people would call for swim lessons, they really knew that, they wanted to learn how to swim, and I would just have to sell them on our competitive advantage as to why we're the best swim school, right? And at that time, the main focus was let's do small group classes, because I noticed at the city, when I was working at the city, we would have 9 to 10 kids even in certain classes.
Yeah.
And so a lot of the parents grew frustration because you have a half an hour class and you have 10 kids. Like, how much attention can you really give to each kid, right? So I just thought, let's split that down to 4, not split even less than.
So that was your value prop. So your value prop was just to
small
have that
group
smaller
classes.
Group. Okay,
small
okay,
group
okay.
classes, more focus and attention on your child, right? More for them to learn. And then obviously there was private lessons too, right? One-on-one, which are the most expensive.
That's where the
lessons.
money's at.
That actually no, because economies of scale, oddly enough, if you have one instructor in the water and you're paying them $20 an hour, let's say, and the lesson is $40 an hour, or $40 for the half hour and $20 an hour. So let's associate the cost of the instructor at $10 for that one class, right? And the kid is paying $40 for that class. But if you're charging $15 for a group class and you have 4 kids, you're making $60 for that half hour versus $40 for that half hour, right? So private is actually doesn't make as much on the profit margin, but it's still hefty for paying for one kid for that much per lesson, right?
Yeah.
So anyways, that was the reason why I thought, okay, swimming is good. And, it wasn't like we had the money to buy a pool, but I noticed that the school board was renting out their school pools on the weekends. So I got permits for the pools, and I asked another instructor at the city to join me, because I was like, I know a little bit of the accounting aspect of things, and I kind of want another lifeguard to help me run the operational side of the business, right? So I had a partner for that business, and we ran it for a couple of years, and strictly on weekends, just 1 day a week. I had the website up, the full online form, you can sign up. I had a friend come in and take a video of us doing lessons one day, and people really trusted the video. We gave our value proposition, and they logged onto the website, enrolled their child, and then I called them remotely, in my homeroom office, and would organize the lessons for Sunday, and everyone would show up on Sunday. Every half hour, right? The instructors switch kids and switch classes, and that was going on through university too. I did that by driving back every single weekend, and I would do rideshare every single time I'd come back. So that's how I was maintaining the car. Like, $15 a seat. Everybody kind of didn't want to take the bus from Waterloo to Scarborough.
Yeah.
So $15 a seat. You sell 3 seats, $45 on the way
And you
back.
drive a
I remember
hybrid, so
rideshare,
you're moving.
yeah.
I didn't have the hybrid at that time, so it was a Mazda 3, but so it still helped.
Fuel efficient.
Still fuel efficient.
So what did it cost you to start up that
the swim
that
school?
business? Yeah.
$1,000.
$1,000.
Yeah, I figured out how to incorporate it online myself.
Yeah.
I incorrectly federally incorporated it, but
We'll talk about when to incorporate.
We'll talk about when to
right?
incorporate later on, but. I incorporated it federally, which wasn't necessary because I was operating only in Ontario, let alone Toronto. So that was funny when I realized I had federally incorporated a couple years later. But anyways, we incorporated it. We needed the money for in order to pay the pool. That was our biggest fixed cost, you could say. And then we just tried to we did flyers at first around the neighborhoods closest to the school pools, right?
That was actually a question I was going to ask you. I was like, what was your marketing? How did you accumulate?
It was pretty basic at first. It was flyers like door to door, and then eventually the website came in, and then we had Google AdWords. Google AdWords was powerful.
What year was this?
Damn, back
you're
then,
doing Google AdWords back then,
It was Google Ads. It wasn't too complicated. You wanted to hit your proposition, right? Small group classes, private classes, and that was the two lines in your Google ad. And
how did you learn Google AdWords back then?
I just kind of logged on, did a little bit of YouTubing and Googling, and really wasn't that difficult. The cost per acquisition, I think the cost per click is about $1 or $2, let's say, right? We would sell, I think, about 9 lessons at that time for, I believe it was about $150, right?
Yeah.
So, $2 or $3 per click. I would say our customer acquisition cost was maybe $10, like $10 or $12 maybe. Like every 3 to 4 clicks was a customer. Like it was really effective.
It was that one video on the website, eh?
The video, and then then you got them to the website, and then they watched the video, they got to know and understand the value proposition a little bit better, and then they would sign up using the online form, and then we would call them and schedule the class. That's
actually the coolest thing about video too, because I find that when no matter what business you do, if it's just a video on a website or just video on like some sort of social media platform, the credibility that you kind of build from that video, it's like absolutely. I think and that's a huge reason now, and we'll get into it later with the real estate. Now I'm trying to do video, right? I think you're doing one right now.
We're doing one right now. Exactly. That's why we're on the podcast.
It's impressive to see that you had everything set up like that back then. And
back then,
Don't get me wrong. It was far from perfect, but it was just a matter of trying to cover the cost of the pool, and we exceeded that pretty quickly. Like the margins were good, and that was another reason why starting that business was good, because not only was the demand good, the margins were good.
Low operating costs
because we didn't own the pool, we rented the pool, right? We'll get into that with Airbnb, why owning the property is sometimes not always better.
So when it came to taxes, can you technically write off the rental portion of the pool?
Absolutely, yeah. You can. You'd write off as many expenses as you incur to run the business, right? So any of the marketing,
Google
AdWords. So any marketing costs, any operating costs, right, including any repairs and maintenance, if you have for a typical business, not for a swim school because we didn't own the pool, but any repairs and maintenance, any marketing, any meals and entertainment at 50%, right?
And for those that don't know, like for those of you guys that are watching and you guys are like, yo, what this guy just said, write off. What exactly is a tax write off? Can you explain a tax write off from a CPA's mouth?
Sure. I think most people at first, when they first hear the word write-off, they think I'm getting the entire money back. That's what I found is the most common misunderstanding. They think they're getting the money back, but really what it is instead of paying the tax on that income, you're deducting an expense, and therefore you're not paying the tax for that amount.
Because it reduces your
your tax liability. So if you have $5 in income and you have $2 in expenses, well, you're not going to pay tax on the $2 because you have an expense for that, right? So you're reducing your tax liability is in essence is what it is.
Okay.
Right. So I guess, fast forward to the swim school. So the swim school happens, and while I'm running the swim school on the weekends, I'm at Laurier doing business. And the reason why I got into business in high school, initially I wanted to be a lawyer. I liked kind of advising people on their situations and what to do. And
you still do that.
I still do that. Well, I get into why I did the CPA in terms of that instead of doing the law route was because I think in undergrad I realized, you know what, like this is 4 years of undergrad, $70,000 later, I'm going to basically go and spend another $120,000, right? About $100K, I think, for just the tuition if I'm in Toronto, right? plus, other incidentals. Let's round it up and call it about $100,000 for law school, right? And then after I did my CRA co-op terms throughout university, I got offered a full-time position as a tax auditor. So that was starting about $60K, like out of school, right? So I did the math and I was like, okay, $60K at 4 years, I'm gonna forego to go to law school. So that's $240K there that I'm foregoing, right? Plus the $100K I'm paying to go to law school. And then there was a pre-construction condo. We'll get into that later. The first condo that I bought that had gone up by about $150,000 at that point. So I would have had to forego that opportunity as well, because I would have been in school, had no income, no way to mortgage that condo.
Okay.
Right?
What year was this?
So this is now what year when I bought the condo? Or?
Yeah.
So it's about third year now that I get the full-time job offer for after school, and I buy the condo shortly after that, because I know in 2-3 years when it's built, I'll have that income to mortgage it with, right?
Yeah.
So when I'm making that law school decision, I'm essentially weighing all these opportunity costs. So let's just say $150,000 for the condo, unrealized gain, but later becomes realized, and $150 for the condo, $240K foregoed income, right? So that's about $390,000 opportunity cost, plus the cost to go to law school, which is about $100,000. So that brings you to $490. So I was basically saying to myself, I'm gonna put myself $500,000 behind if I go to become a lawyer. And did I think that was gonna set me back more than I could have? I did think that. I didn't really think about, okay, how much do lawyers make? And only thing I thought of was, okay, maybe a starting lawyer on average will make about $70,000 in their first year. And I was thinking, okay, the CRA position is paying me $60,000 with my current.
Not a crazy return on investment.
Excuse me. Not a crazy return on your investment. Exactly. Yes, you can make partner and you make $500,000 one day.
Later on in your career.
Yes. Though, right? So that's when I started to look at, okay, I know I like advising people. I know I want to be in a role where I have a framework and I look at a situation and I advise based on that. So I started looking at accounting, and I realized that, okay, you know what, I'm in third year. It's not too late. I can do my accounting electives, my tax electives, and follow the CPA route. And the reason why I did that was because, one, you can work while you're doing your articling, not articling, but work experience is what they call it. So there's 2.5 years, 30 months of work experience to become a CPA. But you're making money during that time. It's not a lot, but you're making money. And I realized that income was enough to keep the condo. And so I decided to go that route, because all the exams associated with the CPA as well were covered by the firm, right? So that was an added bonus, because you're not out of pocket on educational costs, right? So they're covering your exams. You're still making an income. And I'm able to, keep the condo, which was the huge.
That was the main thing.
That's crazy, bro. It's crazy. It's really cool how calculated you were, like, at that point in your life, and looking at all these things.
It was crazy. Even in grade 9, when I wanted to be a doctor, I was in grade 8. I had all the courses from grade 9 to 12 laid out, and things changed. Like, I even from going from wanting to be a doctor to going law was because I went to high school at Mary Ward. It was self-directed.
I think that actually put you like way ahead.
It was a really interesting school to go to.
Yeah. So those are the guys that don't really take in what self-directed means. You want to explain what the self-directed concept was?
I'll explain Mary Ward, which is actually an amazing school. So it's a high school at Kennedy and McNichol. It's very different. So you show up what's normally called homeroom, but it's called TA at Mary Ward. So TA because you're meeting with your teacher advisor, right?
Yeah.
And your teacher advisor teaches many subjects and has their own classes, but has about 20 kids in the morning, which is called TA, that they kind of look after and help keep on track. So every course at Mary Ward has 18 units, and the 17th or 18th unit is a culminating activity or final exam, right? So at that point, you have the full 17 units to get complete throughout the year. And there's target deadlines, which kind of are like, you should have unit 1 done by this time and unit 2 done by this time. But it's not a hard deadline, right? So you submit your units and you're given all 8 courses at once. So it's non-semestered in that sense. So you get 8 courses at once, 18 units, right? And you got to get all 18 units, all 8 courses done by June. And if you don't, there's summer school option and carryover option, right, for those units that you don't complete. But in essence, in the morning, you'll schedule your agenda saying first period, I'm going to show up in the math area and I'm going to work on unit 2. But your friend could still be on unit 1. And so you go to that area, you work on your unit, and usually you'll schedule yourself to be in an area where, let's just say you're working through the unit and you have a question on a particular topic. The teachers will have floor schedules. So the teachers will say, I'm in the math area, first, third, and fifth period. So you could schedule to be in math first, third, or fifth period, to write your name down on the consult list. And then once the teacher calls your name up, you go up, ask your question, and then continue in your unit. And you're probably wondering how tests work. Every, let's just say fourth unit, for example, in geography has a test. So you get unit 4 done. Once you get unit 4 done, you get a test code in TA in the morning. And you have 6 days to go write that test in the test center. And the test has different versions, A, B, and C. So, if you write the test before me, where our tests are not the same.
Yeah.
Right?
So
anyways,
is this the only self-directed school?
I think there's like 3 in Canada or 5 in Canada, something like that.
It's
But
very different. I've never actually
it's
heard
different.
about this.
It's different, but it's publicly funded schools. So all the feeder schools, like the schools in the area, it's not like you need a special requirement to go to the school or anything. It's like anybody can go to the school.
Okay.
It's just a different concept.
How did you go there because it's your homeschool, or is it because
I went there
choice?
Specifically for the self-directed learning. So think of it this way: the way you kind of operate in university is how this high school pretty much runs. So you're kind of getting hit with that concept in grade 9, independent learning in grade 9 versus in first year university, right? So when you get to university, it's very
you're more prepared.
You're
more prepared. Yeah.
So kind of like how they have lectures in university, they had seminars in high school. So for every math unit, there was a seminar, and it was mandatory. Some seminars are optional. So in science, there were optional seminars where if they thought a topic was difficult to understand, you could attend and sign up for the 1-hour seminar, go and learn about it. But it wasn't mandatory to complete the unit.
How do you think Mary Ward as a high school, how do you think that's kind of shaped you into the person you are right now? And what kind of competitive advantage do you think that you have now that you've went to school at Mary Ward?
I think I had the competitive advantage in university because I already knew how to manage, the workload pretty well with minimal teacher guidance or assistance, right? And I think all the students who went to Mary Ward really learned that, right? And I think fast forward, all the skills that you learned, which was time management, discipline, right? Like focus and all those other things, you have to be self-motivated and driving yourself, right? Which I think is huge for being a business owner, right? And, the units didn't get done themselves, and you didn't go to math class every day and the teacher was kind of behind you, right? You had the units and you had to get them done, and it was pretty. You had to drive yourself to get that done.
You had to be responsible from a young age.
You had to be responsible, yeah.
And I also noticed that, like you said, you were a manager since you were 19 years old.
At 19 afterwards.
At 19, yeah. So I guess all of that kind of just transitioned into you just being, I guess, a more put together person at a younger age, no?
Yeah, I think all of the skills that you learned at Mary Ward just, kind of fast forwards adulting a little bit, right? And that helped for sure. I would say it helped compose and get you ready for the next steps. And then university, prepares you for the next steps too, right? Certain things and aspects of that.
Okay, so going back to the CPA.
Sure. Yes. So then basically I determined at that point, the opportunity cost didn't make sense to do law.
Yeah.
So I ended up working at the CRA, learning a little bit more tax on top of my co-op terms. I did that full time for about a year. And then I thought it was time to learn a little bit more accounting and audit. So I jumped over to the public accounting firms at that point. Did a little bit of public accounting to finish off that 30 months. So basically that 30 months was broken up over some tax audit experience and then accounting audit experience. And then in my 30th month of experience in the accounting firm, basically COVID hits. And so COVID hits. And they temporarily lay me off at the accounting firm for about 30 days. And mind you, while all of this, so at this point I've been working in accounting, been doing the swim school on the weekends, and I used some of my vacation time to get my real estate license. Yeah. Because the pre-construction condo made me realize real estate was gonna be one of my passions, and I thought, having the license at that point is also something that I wanted to really be the end goal. At some point, through the CPA, I realized, okay, I actually wanted to be a realtor, and we'll get into that with how the pre-construction condo kind of influenced me with that. But
what about that pre-construction condo that sparked that realtor interest in you? What was that?
I guess what ended up happening was when I closed the condo, I realized, wow, this has gone up by about $150,000, right? And that was a huge light bulb moment. I realized I was a pretty novice investor, so I don't want to, make pre-con investing sound really easy and simple.
Yeah.
Back in the day, I want to point out a huge difference between pre-con now and pre-con then. Pre-con then, I would say if you saw a 4-bedroom home on the street or a 2-bedroom condo, for example, selling for $400,000, the pre-con condo was probably selling for like $450 or $440, right? It wasn't that much of a premium built in to get the new condo, right? For me, the reason why I kind of saw pre-con as the strategy, one was because I was kind of ignorant in the sense that I didn't know anything about the BRRRR strategy. I didn't know anything about the buy and hold, right? I just knew about pre-con because my parents, the first house that they bought was a pre-con property, right?
What is the BRRRR strategy for the people in the back?
BRRRR strategy is, buy, renovate, rent, refinance, and repeat, right? And what that strategy is you're essentially buying a distressed property usually. You're renovating or rehabbing that property and bringing it up to a good standard where it's going to be appraised for a higher value.
Forcing that appreciation.
You're forcing that appreciation, right? And that's where I don't want the pre-con. Pre-con relies strictly on market appreciation. You don't have a lot of control over the appreciation. You're depending on the market a lot. Whereas the BRRRR strategy, you can force the value of the property up. And then at that point, you're going to refinance based on the new value, hopefully pull out all the capital that you invested into the property plus the renovations, which is what people call a perfect BRRRR. If you don't have any money in the...
And then you also have the regular market appreciation that happens as well. That's just like a bonus on top.
That's a bonus. That's a bonus.
Or your savior if you're a dumbass.
Exactly.
And you also make money on the buy, right? If you buy a distressed property, right?
Well, that's where the money's made, right? Even on a flip, the money's made on the buy. You hear most people say, right?
Yeah.
So, say at that point you refinance, and then you're gonna rent it out at a higher market rent because the property's obviously brought up in terms of its value, right? So somebody's gonna want to live in a newer 3-bedroom apartment than a dingy 3-bedroom apartment, right? So the rents come up, and then hopefully you're buying a property in an area where the rents cover the mortgage much more than the mortgage, and
have a little bit of cash flow.
Maybe you cash flow, right? If you cash flow, then you're doing pretty well in terms of covering your monthly expenses. But again, at the end of the day, I think real estate, and even for me, it took a few years and after buying a few pre-cons to realize that the money in real estate is made in the equity, not in the cash flow, right? The cash flow is kind of just a reserve for the day-to-day expenses, right, of the property, because it takes some time if you're buying an older property to stabilize the property, right? You're gonna have maybe a new roof, new hallway carpets,
leaks,
right? So you're gonna have maintenance that you're gonna have to do when tenants complain, and usually you want to keep your cash flow for that, right? And then really the wealth in real estate is generated by the equity over time, right?
It's even in all of in every aspect of life, it's ownership that generates the most amount of money, right?
Exactly. And on the topic of renting, I'll share a story about renting. So most people think, I'm going to buy an investment property, I'm going to rent it to a tenant, everything's going to go amazing, right? But it's just like any other business, right? You're going to run into trials and tribulations and problems, right? Or else there's no profits, most people like to say, right? So going back to how I kind of got the idea of getting into real estate, my parents had one rental property. So that was the first ever home that they purchased outside of, getting us out of the apartment, right? Everybody comes to Canada, immigrant families, the first house is usually an apartment, not in the greatest area, right? And so at that time,
also
like I was saying,
multifamily investment.
Multifamily investment? Oh, we weren't in a multifamily; it was a condo building. But
okay.
As I was saying, my parents were delivering the papers back then, and Mattamy Homes always had the back page, right, of the Toronto Sun. That was probably the most expensive ad, and they were making pretty good money. I mean, if you know Mattamy Homes now, they have a lot of projects, a lot of land, they've done really well. So my dad saw Mattamy Homes on the back page of Toronto Sun, and that was in the Staines community. So what everybody refers to now, Staines, which is Markham and Steeles and Morningside and Staines area. In between there, that whole neighborhood, that entire neighborhood was just dirt at one point, right?
Wow.
And
Yeah.
this is back in 2000, right? So in 2001, so I remember still going into the Mattamy office and my parents buying the first home, right? So they booked it in 2001, 2003 it was built, right? And we would drive into the area and there'd be like, no real roads, and you just see a stick in the ground to see like that's your lot, right? So back in the
Were
day,
your parents like into like
They're su-
numerology and stuff, and did they look at all these kind of
believe
things?
it or not, they were not really
Okay,
that into that. But I do run into that with some real estate clients where my client will be like, "Oh, we can't have a 5 in the house." And I'll say to them,
My parents are
well,
like that.
I'll say
so-
to them, but I'll be like, "What if it's under market value?"
What
What
do they say?
matter then? And
She's
then-
like, no,
and
I
they're
can't
like,
do it.
Yeah, no. But surprisingly, that particular client's parents actually were really happy with the unit, and luckily that number didn't show up in the unit that we bought.
Yeah.
Fast forward to 2003, we move into the first property, and in
Yes.
front of that property, there's land that behind it there's a concrete fence, and then there's a railway track. And I think Mattamy had some trouble with the city getting permission to build on that land because of the proximity to the railway. And so from 2003, we move in. Around 2007, they start selling the homes in front, right? And we kind of realized that, this we're in a semi-detached and only has one car parking. We kind of wanted to get a bigger home. So my dad booked the next property that we lived in across the street from where we currently lived. So then 2009, when that came up and was built, we moved there, and then my dad did something where this is where like the light bulb went off for me too about renting. He decided to rent out that property, and that was my first exposure to kind of realizing that you can rent out real estate, right? And going back to from paper delivery to then owning a rental property and having income come through there, I realized that, hey, you don't really need to work that terribly hard to make an income, right? It doesn't always have to be like that. And I realized that property really was what kind of brought us into the middle class, right? And with that additional income. And when I had seen the appreciation from when we had bought the first property from 2001, and then we moved in 2003, to when I saw what the properties across the street were selling for in 2007, I realized, okay, look, we've made this much in equity off the first property. And that's how my dad was kind of able to leverage that property and buy the second property that we moved into, right? And so that's kind of what gave me the idea that, hey, I really like real estate, and I kind of wanted to get into it. And then fast forward to the third time my dad ended up turning over tenants. We had a really smart professional tenant, I think is the word for what these tenants do. And mind you, I want to preface this by saying like 99% of tenants I want to say are pretty good tenants, right? Like they pay their rent on time.
They're not
they
trying to
take care
cause
of the
problems.
property, right?
Yeah.
They don't want to cause any problems. They just want a nice house. They want to live with their family, right? And you will get the bad apple every now and then, right? And this is why you want to know what to look out for when you're renting your property, and we'll get into that and how to prevent some scenarios like that. But this particular situation, this lady owned a condo. We found this out afterwards. So anyways, she starts renting the property, and eventually she stops paying rent. And so she stops paying rent for about 3 months, and we have to go through the landlord and tenant board. And for those who don't know how rentals and disputes are handled, it's handled through a tribunal called the landlord and tenant board. And so they oversee any disputes between landlords and tenants across Ontario. And so whenever you have an issue, whether that's, one tenant in the upstairs unit is disturbing the tenant in the downstairs unit, and after a certain amount of notices, you take them to the landlord tenant board to evict them on that basis. Or if there's non-payment of rent, you can evict them based on the fact that they're not paying rent. So all that has to go to the landlord tenant board.
How many months of non-payment does a landlord have to kind of justify with the landlord and tenant board to provide like an N11 or whatever?
So I'll go through the form. So the first step is you have to provide an N4, which basically is a notice to the tenant that says, hey, you failed to make your payment of rent. And you can issue that. You can't issue that on the first of the month because the first has to pass. So let's just say it's June 1st. They owe $2,500 in rent. They haven't paid the $2,500 in rent as of midnight on the 1st, right? On the second day of the month, you can serve an N4 which says, hey, you're behind on rent by $2,500. You have 2 weeks. So you'll set a date in the N4, which is 2 weeks from the date you serve the notice. And if they don't pay the rent by then, on the notice it says your lease will be terminated, right? And so that 2 weeks has to pass in order for you to take the next step, which is filing an L1, which is an application to evict a tenant based on non-payment of rent. Right? Now, if the tenant pays the rent in that 2-week period, the N4 gets scratched and there's no issue, right? Because they've paid their rent. If the 2 weeks passes, you file the L1, and then it's about $186 if you file it online. Now the landlord tenant board's gotten a lot better online because of COVID and whatnot. A lot of the hearings through COVID actually happened on Zoom, and I took part in one of those as well on behalf of my dad. We'll get into that story as well. But anyways, you file the L1, and eventually you'll get a hearing date. And once you get a hearing date, at this point, you'll get another form closer to the hearing date to fill out and update the board as to how many months of rent now does the tenant owe you, right? Now, mind you, if the tenant comes up to speed on the rent before the hearing date, well, then the L1 is scrapped and there's no hearing, right? Because they're up to date. Mind you, that doesn't always happen. Most likely, if they haven't paid rent for 2-3 months, it's gonna mostly continue on.
They're one of those bad apples.
Yeah,
at that
exactly.
Point. Yeah.
And so the average time to get a hearing pre-COVID was about 3 months, I would say. Post-COVID, even now, we're seeing hearings that are I know some people who have had tenants who haven't paid for a year.
Oh my goodness.
And haven't gotten a hearing, right? So back then,
And mind you, during this period while you're waiting for the hearing, you're still paying the mortgage on that house that your professional tenant is not paying.
Exactly. You have to cover all the operating expenses of the rental. It's illegal to turn off the electricity, to turn off the heat, right? Those are mandatory things that you need to upkeep as a landlord. So you want to always make sure too that just because your tenant stopped paying rent, you don't meet your obligations as a landlord. Because when the hearing comes, you want to show the landlord and tenant board that, hey, as a landlord, I've kept all my obligations and the tenant hasn't, right? And that's how you kind of win the case, right? And then eventually get your tenant evicted. So the hearing date comes, the tenant shows up. If the tenant doesn't show up, it's a default judgment, right? You get the judgment automatically. If the tenant does show up, they say their side of the story. And in genuine cases, right? Like if your tenant has missed a month, but they've paid half a month, like maybe they lost their job. Maybe they're in the process of getting a new job.
Case.
If they're trying, you want to do your best to resolve it with them, because sometimes you have a good tenant who's been paying for a year and then they stop paying all of a sudden. That's usually not a bad apple tenant. That's usually a tenant who's just come through a difficult circumstance, right? So if they actually are going through difficult circumstances, they can kind of appeal to the landlord and tenant board. I don't want to say appeal in the word of like, you have a judgment and then you appeal that judgment, but they just kind of advocate for themselves, saying that, this is my current situation, right? But in cases where you haven't received rent for 3 or 4 months and they haven't paid a cent in rent, this is a tenant that doesn't want to pay rent, right? So you get your judgment and it doesn't stop there. So let's just say everything goes well. They haven't paid their rent. The landlord and tenant board sees that. They give you a judgment saying, okay, I'm just going to say, John, you have to be evicted you have to leave the unit by, let's just say it was June 1st. They didn't pay their rent. You got the hearing in August. And the judgment says you have to leave by September, right? This is pre-COVID timeline. If it's now, it's probably be a year later. So August, they have to move out. If they don't move out voluntarily, then you have to take your landlord and tenant board judgment and go to the sheriff's office. And I would say you want to do this as soon as you get your judgment, because there's also a time period at the sheriff's office, right? So you go to the sheriff's office and the sheriff will then show up on a day where they physically evict the tenant and have them physically removed out of the property. Wow. If it comes to that, right? Okay. So that's kind of the process. So it's an N4 to the tenant to say, hey, you failed to pay your rent. An L1 at the landlord and tenant board to file application to evict. Then a judgment comes down. And then to enforce the judgment, to physically evict them, you need the sheriff. Now, what happens with the rent that is still owed to you, right? That's where you take the landlord and tenant judgment, and that judgment is actually recognized in small claims court. By the way, I want to just put a quick disclaimer. This isn't legal advice, right? It's just for informational purposes. But
for sure.
Yeah.
The small claims court will recognize that judgment. So you go directly to small claims court, you show them the judgment, they'll give you a judgment at the small claims court level, which then allows you to enforce the judgment, right? Enforcing it simply means how do you actually get the money back, right? How do you actually get the payment from
Those
the
missed
tenant.
payments, yeah.
How do you get those missed payments? So
You could essentially sue them, right?
that's just like, well, there's no suing because the landlord and tenant board has already determined that tenant owes you the rent. So that judgment says that they basically owe you the money, and the small claims court then gives you a judgment at that level that says, hey, yeah, they still owe you money, right? And then the two methods of enforcement are either through a lien or through garnishment, right? So in order to do a garnishment, which is, you're garnishing wages, so the employer, by the order of the court, has to deduct a certain amount of wages, and it has to be reasonable, right? Like they can't deduct all their, they can't go hungry, and they have to live somewhere, right? While they're paying this debt back to you. But mind you, you have to know the employer, you have to know where they work in order for that to work. A second way,
that's why it's good to get all that information
when you
before.
start. Yeah.
But they could simply change jobs on
Of
you,
course,
and
of course.
then
Or
you-
they could provide false documents.
That's
and
true,
then,
too.
That
But
too.
even then, if you don't do your
due diligence, then
exactly.
we'll get into doing due diligence too. But essentially, at that point, you can either garnish, right, which we talked about, and then the other ways of enforcement is through a lien, right? And a lien is on their name, and it applies to any property that they own, right? So essentially, they can't sell that property unless the lien is, or the judgment is paid out, right? So, and it's actually called a writ of seizure, and so the writ has to be paid out before they can sell the property. So now, mind you, most tenants don't own their own property,
yeah.
so doing a lien is usually not your usual method of enforcement.
Yeah.
It's usually garnishment of wages. But in this particular case, my dad actually had a tenant who owned a condo, and she was renting this condo out, and I'm assuming she was kind of employing the strategy where she was renting out the condo because it was too small for her, and she was renting a 4-bedroom house from us because she had a more
Bigger
extended
family.
family, a bigger
Yeah,
family,
yeah.
right? So anyway, she stops paying rent for 3 months, and then my dad follows the procedure, serves the N4, does the L1. She doesn't show up to the landlord and tenant board, so he gets the judgment, takes the judgment to small claims court, and then we get the judgment there. We try to enforce it. So she switches jobs, so we were not able to figure out where she works anymore. And at that point, we do find out that she owns this condo because it's the address on her license, right? Because you collect ID when you lease a property to a tenant, right? You want to collect ID, you collect employment information, pay stubs, whenever you're doing your due diligence. So we find that out, and then we put a lien against her name and on the condo, right? Now, mind you, the writ has to be renewed every 6 years, right? So we basically put the writ, and remember, you essentially have to. You could force a sale, but that's another procedure. You have to go through the courts, right? So we kind of just applied the writ. My dad didn't even probably know about that at the time, I think. So we put the writ, and 5 years passes by, and at this point, I'm a realtor. So I'm just kind of thinking back to this case that, mind you, happened in 2013. So now it's probably 2021. Okay, so the case dragged on, and then there's a writ in place. So 5th year of the writ, we ended up finding out. So I'm now I have access to Geo Warehouse, which is essentially a system that allows you to see who owns what property and whatnot as a realtor. So I search up the address of the property on MLS, and I realize that it's sold. And I'm thinking, and I look at the closing date, and I'm like, how did this property close without my dad seeing his money, right? So I started doing a little bit of digging. I started looking at the co-op office on, who co-opted on the deal, who sold the property, and I started digging down and figure out who the lawyers were on the deal. And so once I figure out who the lawyer was for the sell side, which is representing her, I called up the lawyer and I say, well, why wasn't the writ paid out? And he said, well, the property was sold subject to the writ. And I was like, what do you mean the property was sold subject to the writ, right? He said the property was sold subject to the writ. So he's pretty tight-lipped about it. And then I obviously got my lawyer involved, and I was like, what's going on here? Is this allowed? And he said, yeah, they actually registered it. So the buyer's side lawyer actually agreed, and I have no idea why they would agree to this, right? Agreed to take on the writ. And I think the agreement was that the closing date was August and the writ was going to expire in October. So I think what I ended up figuring out what they were trying to do. The lawyer was trying to figure out whether we would renew the writ. And if we didn't renew the writ, then they could just the writ would fall off, and that's it, right? So I think the agreement was we'll hold back the money in trust if the writ doesn't get paid out, or if the writ doesn't renew, then perfect. Well, my client will get her money back. If the writ does get renewed, we'll have the money in trust ready to be paid out, and we'll solve it. So
how often are you supposed to renew it?
Every 6 years.
Every 6 years, okay.
Every 6 years it expires, right? So you got to do it before the anniversary of 6 years, right? Okay. So I call the lawyer and I tell him, listen, we're gonna renew the writ. Like, we're gonna renew the writ. You're gonna pay out my dad. You know, this is you're basically playing games at this point, right? So October comes around, we renew the writ. You could renew it way ahead of time too, but we renewed it closer to the date. We renew the writ, and then in February I get a call from the tenant's lawyer who represented her in the sale, saying, hey, we're ready to pay your dad out. So we calculated the interest down to the last day that he went to pick up the check. And so a debt from 2013 that I think was about $3,000 something with all that annual interest added up to, I think it was close to $5,000, $4,900, right?
Okay. So how's the interest calculated in this scenario?
The interest is calculated. So when you get the landlord and tenant board judgment, there's a formula where there's the amount of rent that you're owed plus the cost of filing the L1 plus the interest rate on the judgment.
Okay, right? So the board already predetermined all this stuff.
It's predetermined.
Okay,
Okay. And I think it's a legislated amount of interest. Don't quote me on that, but I think it changes based on the interest rate environment, right?
Okay.
So essentially, he gets the money paid out, and that was a long. So you could see 2013 to 2022 is when he finally saw the money, and that was only because the tenant owned a property.
Oh, okay.
Right, okay. And we had a writ on the property. Most times, you're gonna most likely write that off as a bad debt.
Bad debt, yeah.
Bad debt. So for tax purposes, if your tenant doesn't pay you rent, you can write that off as an expense called bad debt. Right?
It's kind of like a loss.
It's a loss.
Yeah.
Exactly.
On the bright side, you still made equity in the house.
Exactly. On the bright side, hopefully. If again, market appreciation, right? Which for the last few years has been outstanding.
Quite phenomenal,
right? Quite phenomenal, yeah.
One thing I want to ask you, I feel like a lot of people out there, they don't get into real estate in terms of the investing side and renting it out to people for this very reason, right?
100%.
So, like, what would you have to say to these kind of people that might be worried, like, you know what, I really don't want to do that just in case these kind of things happen?
Sure. I think number one, you have to understand that real estate, and especially renting, is just like any other business, right? You're going to run into problems. Most people like to call rent passive income, right? It's not really truly passive until you're not involved in it. And so for people who don't want to be involved in the day-to-day activities of, renting property,
hire a property manager.
You beat me to it. So, people who own like 20, 30, 100 units, obviously they're not managing every single thing by themselves. They have a property manager, and you want to have a good property manager.
Some people are crazy. Some people enjoy that shit. Some people are like,
yeah. If you own 1 or 2 units, it's not a big deal. And if they're in close proximity, but if they're far away and you don't want to deal with the due diligence, you get a higher experienced property manager, and hopefully more times than not, you'll get good tenants, right? Key is if you're relying on it as passive income, you want to account for the property manager cost and all that other stuff and make sure you're cash flowing.
What is a standard percentage a property manager takes?
Anywhere between 5%, I think, is the standard. Up to 10%, I think I've even heard. But
I think it's 10 to 12% if it's like more hands-on landlord, like Airbnb and stuff, short-term rental.
I think Airbnb actually is a share of the profits. Share of the rents, I think it's like 20% revenue share.
I guess it just depends on the company.
It depends on the property manager,
the contract,
and it can be done many ways. Airbnb is pretty flexible, but anyways, that's really what if you don't want to be dealt with it, hire a property manager. But just know that even if your property manager does all the due diligence and somebody slips through the cracks and you don't get rent for like 3 months, or 6 months, you should have the wherewithal emotionally to deal with that, and second of all, financially be ready for that, right? And have cash reserves to be able to carry the property. Let's just say if a tenant, I would say today, if you're gonna buy an investment property, you should have at least 1 year's of operating expenses always in the cash reserve, right?
Okay.
Just to be able to carry the property in the event the tenant stops paying. Because if the tenant stops paying and you can't pay that property, that means you're over leveraged, right? And you never want to be in that
It's a very
position.
good tip for sure.
Great tip.
Now you can see, like, look at what's happening to the market, right?
Yeah.
And things shift, right? It's not always a rosy market. I know it has been for the last 3 to 4 years,
Yes.
but there are changes, right? 2017, we saw it when the foreign buyers tax came in. There was a little lull in the market, and then things picked back up. Right now, we're seeing it with rising interest rates, right? So, in every market, in every business, right, there's external factors and industry, impact and variables that you can't control that you have to monitor.
So that was a great story you gave us on landlord tenant and what it takes to essentially own a rental property.
Yeah,
but
and going through the trials and tribulations, because it's not always rosy like most people think, like owning 100 properties and all your tenants are paying all the time, right?
Yeah.
So we went into that issue, but
so let's go back to the CPA and how you got into real estate.
sure. So like I said, first property kind of spun the idea of, I really do think I want to do this full time. And like I said, I'm still young at this point. I went kind of from being a doctor to being a lawyer, and then figuring out that CPA was kind of the best way to have that advisor role, but at the same time not have to lose out on the opportunity cost. So now I own the condo at this point, and I've done the real estate license, but I'm not doing it full time because I really think real estate is a career where you need to be into it full time in order to really be a good realtor and serve your clients at full service, right? Because you need to be able to answer the phone. You can't do a 9 to 5 and do showings all the time after 5 o'clock, right? Even though that's when they usually are. And so I really didn't get into real estate, even though I had the license, until I finished my CPA. So the goal at that time was, let's get the CPA done. Let's get the work experience done. And I felt like I was so far in, I wanted to get it complete. And, parental expectations too, even though I want to say my parents never ever forced a specific career on me, or they were really understanding and forgiving in terms of like how many times I kind of switched and wanted to do different things. So anyways, I did the CPA, and then the 30th month, as I was saying, I basically got laid off for 30 days for COVID, because every business at that time, I think, was laying off employees or just trying to figure out how's this thing going to spin out. And taking the safer bet by laying off some employees. So I was one of those employees. And at the same time, COVID, because of the nature of what it was, the schools stopped permitting out their pools because they wanted to limit the COVID to maybe just the classrooms, and they didn't want people outside using the pools on the weekend.
Oh, you still have the pool business at this point.
I'm still doing this on the side on the weekends, right?
This guy's a savage.
So I'm doing the swim school on the weekend, just on Sundays, and Monday to Friday working as an accountant, right? And it was pretty manageable business. Like honestly, both of those was just kind of like having a weekend job and a regular full-time job.
Because I'd imagine there's no like follow-ups or like weekly.
There still was calls
with the swimming,
but I would set the hours from like 5 to 9 p.m. So people would call and inquire after they'd finish work anyway. And so I'd have the cell phone on for that, and I would answer questions after work during the evenings and weekends. And people would show up on Sunday for their actual lessons.
Have you, were you like cross-marketing and like kind of converting your
I
swimming
did have
school?
I had one or two clients like that, because I'll kind of get into that in a second. So basically the swim school gets shut down as well at this point, right? So my two main sources of income get shut down. And for the longest time, like I said, I wanted to get the CPA done before I could get into real estate. And there was a point where I was like, should I just stop this and just jump into real estate full time? But, I said, let's finish it. And coincidentally, that 30th month was when I got laid off. So I got laid off. And in that month, I decided that I was going to do real estate full time. So essentially, I said, I don't want to ever rely on an employer ever again after going through this, because I had a mortgage. I had 2 mortgages, and I was pretty. One of them, mostly was covered by a paying tenant, luckily. But at that point, it was a stressful situation. So I kind of was forced into real estate. I kind of just jumped into it. There was a 6-month deferral on mortgages at that time when COVID hit, right? The big banks were giving that out as a COVID relief, because a lot of people
apparently
got laid
that
off.
shit like just completely fucks up your credit.
No, it didn't actually. Not at all. No.
But it looks bad on your file if you were to do that.
No. If you took it, which a lot of people took it, all
Really?
that happened was the interest that so at first the banks were doing interest on that interest for that 6-month period, and then they refunded everybody the interest on interest, but the additional interest you accrued on the balance was accruing at a higher principal, right? Because you were not making principal payments for 6 months, so the interest accrued onto the balance of your mortgage, right? So you had a little bit of a bigger balance, but essentially the goal was to give people a relief in terms of their cash flow at that time,
which I'm
right?
sure helped a lot.
100% helped me, right? Because I basically transitioned into real estate full time, and things were really good. I ended up, really leveraging my sphere of influence, and luckily during COVID, real estate picked up. The first 3 to 4 months were a little bit shaky. People didn't know what was going to happen. People thought the COVID was going to trigger a recession. And anyways, later on, that didn't happen. The market went up, as we all knew, and went up insanely over the next 2 years from that point. And I was lucky enough to transition at that good time. And so I started selling pre-con. I started selling resale properties, obviously, right? And I kind of want to preface again, like going back to pre-con. I don't know if I finished the point on at that time when I bought my first condo, right? Like I said, a 2-bedroom condo resale might have sold for $400, and a pre-con was probably like $425, $430, $440 maybe. And you kind of wanted to buy a new property because if it was your principal residence, you kind of wanted something new versus something old. You liked the fact that you didn't have to put the entire down payment up front, and you could make payments towards it.
Payments were spread out amongst a longer term and stuff
then,
too.
Closing was 2 years from now, and so on and so forth. So the biggest advantage there was that, you're gaining some equity while the property was being built because the market was appreciating assumably, right? That's the biggest thing about pre-con. But nowadays, pre-con is pricing in a lot of the future market appreciation. And that's why the pre-con strategy, I don't really recommend it for most of my investor clients. Like, I don't think it's the best investment. I think there's better ways with real estate. Like we were talking about the BRRRR strategy, to really have more control over the investment. Whereas like with pre-con, like you need to scout the builder. You need to make sure that, the builder has a solid track record with building and finishing developments that, you've heard the stories where people bought condos for 300, they went to 600 and the whole project was canceled, right? So pre-con is a risky investment because not only, especially when nowadays, and this is why I'm saying I don't think it's the best strategy these days, is because a lot of the future market appreciation is priced in today. So you're paying tomorrow's price today, and you don't even know if tomorrow's price is going to be that price.
Yes.
I see.
Right?
Okay.
Whereas when I was buying pre-con back in the day, I was like, okay, you know what? I'm paying a slight premium. I'm not paying like $100,000 premium up front, right? Like, so that's why I was able to make quite a lot of equity gains with pre-con back then, because builders were not that aggressive with the pricing. Now, after the market went up like 2-3 fold in such a small period of time, builders started to get, in my opinion, a little bit greedy and pricing in some of the future appreciation because they saw all these buyers making a lot of money on their product, and they're like, we want a piece of that too.
I don't think it's all greed. I think like a lot of it has to do with like just like the rising cost of like just labor and like material as well.
Yeah.
So I think they're just kind of pricing in the future value as well.
Watching their own backs as well.
Just in case like the prices do go up, they kind of have like a backwind. But obviously, there's going to be greed in there as well. Like, I would say to that point, I would say recently yes, because inflation has gone up a lot. Ridiculous right now. Yeah.
Right, but before inflation started to rise that fast and the market was doing really well, the pricing where they were pricing in more than what they were pricing in previously was getting there. Like, you can't tell me that all this future market appreciation priced in is allocated to rising costs.
No, 100%, 100%.
Absolutely, it is. But I think there's a portion in there where they start to realize we want to make a piece of the pie too.
Yes.
If the market continues to race on the way it is. And that's when you started to see the $0 assignment fees become $10,000 assignment fees. I've even seen some APSs where the builder's now saying 10% of the assignment profit.
What's
10% of the assignment fee. APS is agreement of purchase and sale, right?
Okay.
So your contract when you buy a pre-construction property, right? Anyways, scrolling back to full-time real estate, right? So then I started selling properties resale, and then I was managing some of the properties that I had bought pre-construction. They started to close, and as they started to close, I started to make the decision, like obviously you have to rent a lot of your pre-constructions if you want to be entitled to the HST rebate. So we can talk about that, like HST on pre-construction. So HST, which is harmonized sales tax, right? In Ontario, that's 13%. So I believe it's 8% at the provincial level and 5% at the federal level. That harmonized or together is 13%. When it comes to resale real estate, resale residential, I should say, any resale residential real estate, HST is included in the price, right? You don't really deal with it, so to speak. But on pre-construction properties, HST is a huge factor that you have to take into consideration. Now, when you move into the property that you're buying that's a pre-con, you get that credit on closing. So the CRA basically says the builder has a responsibility to find out what the intention of the use of that property is going to be, whether it's going to be occupied by the purchaser or whether it's going to be a rental property, is determined at closer to closing, right? So if you're going to move into the property, you can get the credit on closing, and so you don't pay any HST, or if you say to the builder, hey, I'm going to rent the property, the builder's going to say, okay, no problem. You're going to have to actually, so the builder then has a responsibility to collect the HST upfront from the purchaser. So if Heaven's buying the property from me and I'm the builder, and Heaven says, hey, I'm actually not going to move into that property. I'm going to live where I'm living and I'm going to rent that property out. Technically, he has to pay all the HST up front to the builder, and that'll be reflected on the statement of adjustments and what you pay to the lawyer on closing. So you'll pay the HST to your lawyer. The lawyer will remit it to the builder's lawyer. The builder will remit it to the CRA, and then the CRA will have it on account that you've paid for the HST. After you can produce a long-term lease. Now, long-term is defined by a 12-month lease. If you can produce a 12-month lease and show it to the CRA, you have to apply for the rebate after the fact, and you apply to the CRA and you say, hey, I've had a tenant in there for 12 months, but the maximum rebate that you can get is, I believe it's $24,000 provincially and $6,000 federally. So $30,000 is your total rebate you can get back. So if you pay anything above and over that, that's out of your pocket, but you're eligible for up to $30,000 of that back if you file appropriately and you follow all the rules, right? And again, not accounting or tax advice. Everyone's situation is different, right? So see your professional and discuss your personal situation because it might be different than the rest. But just general information.
Yeah.
HST is a implication on pre-construction. Now, getting into where now, let's just say you apply for the rebate, you get it back. If you're doing a long-term rental, what if I buy my pre-construction and I start doing Airbnb with it right away? Mm-hmm. Well, now I'm no longer principally residing in the property. I'm no longer hosting a long-term rental. I'm actually doing a short-term rental now. Mm-hmm. So technically, if you're running a short-term rental, you pay the HST up front and you don't get any of it back.
So speaking of HST, what are the income tax implications of rentals?
Sure. So just to be, let me separate the three types of main taxes. There's so many different types of taxes, right? But HST is value-added tax. So that's actually tax that you pay on top of the value that you're buying, right? So if you go to a dollar store, you buy something for $1, it's $1.13. 13 cents is value-added tax. The income tax portion, Dollarama has to report the $1 that they earned, less the cost of what they just sold you. The profit gets taxed. That's called income tax. Getting taxed on your profits, right? So for rentals, long-term rentals in particular, those are taxed passively in a corporation, right? They're taxed at the investment income rate in a corporation, which is the highest tax rate in a corporation. We'll get into a corporation and why. But personally, let's just say you hold your rental property. Your obligation is 1, to report the rental income, and 2, you can report the expenses against the rental income, right? So you report, okay, this is how much revenue I made from my rental. So $2,000 a month for 12 months, $24,000 this year. And then you can deduct your mortgage interest, the mortgage interest, not the entire mortgage, right? So anything principal that you pay down is not deductible. The interest component is deductible. The other things you can deduct include like any repairs or maintenance you did on the property. Tenant called you, tap broke, you put in a new tap. right? Small things like that. And then, so the main ones are mortgage interest, property tax, property management, right? What's the big one? Home insurance, right? So those are your main ones, right? If the rental is all inclusive, you can deduct utilities. If the rent is rent plus utilities, then you can't deduct that because the tenant's paying for that. But in essence, that's the process, right? You report your revenue, you deduct your expenses, and any profit left over, you're gonna pay tax on. Now, you probably hear a lot of people saying, "Wow, real estate is the best for tax," right? Now, you can pay zero in taxes. Now, the way you get to zero in taxes after your rent, less your mortgage interest, insurance, property taxes, what have you, if you have some profit left over, that's where depreciation kicks in.
Mm-hmm.
So
Yes.
depreciation for tax purposes is known as CCA. It's capital cost allowance. So what that is the CRA allows for deduction against the rental income. You can't create a loss. You can deduct against whatever income is left over, about 4% of the building on a declining balance basis. So what that means is, let's just say you own a property that's $1 million. A certain portion of that, the property goes up every year. So you're wondering why? What are you depreciating?
Yes.
Well, the land aspect of the property is the portion of the property that never depreciates, and so you cannot take CCA or depreciation on land. So the CRA will ask you to allocate a cost to the land of the total purchase price of the property. So let's just assume, for argument's sake, 300,000 is the land value
Of that million.
Mm-hmm. So then you have 700,000. That's the
house.
cost that's the cost of the building.
Yeah.
And then you take 700,000 and you get 4% of that. In the first year, there's a half year rule, so you get half of the 4% in the first year, and then starting the second year, you get 4% declining balance basis. So off the balance, it's 4% off the balance every single year as it continues to decline, right? Now, 4% might be, let's say, $2,000, just for argument's sake, and the profit you have is $1,000. You can't take the full $2,000 and be in $1,000 loss, right? You can only take $1,000 of that CCA
and clear
and write it off against the $1,000 in income you have, and then you get to zero in tax. But what is the long-term implication of taking that CCA deduction? Well, if you own the property for a long time, you can continue to deduct CCA, and that'll come off the cost of the building. But the day you sell that building, right, all the deductions that you took for CCA get recaptured, right? So it's called recapture, but you basically recapture all the deductions that you took for CCA purposes, and that gets added back, right? So you're going to end up paying tax on all of the deductions you took if it's a rental property, right? But if you hold that property and you think
If
it's
you're
going to be...
if
you're just holding and holding, then you're going to have that deduction probably every year until that 700,000 gets close to zero. But mind you, if you, in the 5th year or 10th year of owning that rental property, do 60,000 in renovations, you can't expense those renovations. You actually have to capitalize them. So that 60,000 gets added to the cost of the building, and then you can depreciate that 60,000.
You have more room to start depreciating.
You have more room to start depreciating on that basis.
So what you're saying is the tax system essentially incentivizes buy and hold. Does it not, or no?
Absolutely it does. And you see that even you'll notice tax is very logical, and there's policy behind the tax, right? Like, you have to understand, why is the HST rebate given? Why is there a rebate when you offer a 12-month lease to a tenant? Well, because the government wants to increase housing supply, and so they want to incentivize the people who are buying pre-construction that, hey, if you rent this out on a long-term basis, you'll be able to be eligible for the rebate. You know what I mean?
Yeah.
So isn't that what really taxes is? It's kind of like a rule playbook, and then
exactly
whatever
you try to play by the rules the best you can.
Yeah. Exactly.
The least amount of tax.
And then as long as you do what the government wants you to do, you get a reward back, and that could come back as like a write-off or Exactly.
Well, there's a reason why business owners are incentivized more than employees, because Businesses have more flexible deductions because we need businesses to employ employees.
Exactly.
Yeah.
That's what runs the economy.
So the
right?
government wants
Yeah.
to incentivize the economy. In order to incentivize the economy or incentivize business owners to induce the economy, right?
Yes.
You got to incentivize.
So
them.
so it's not an inequality as people would like to.
Yeah, there's
So,
different perspectives on it,
Yeah.
right? But I think risk and reward, right? Business owners take on
Take
more
so
risk,
much risk, right?
right? They take a
100%.
lot of risk. They take investment risk, right, with their money, their capital, what have you. So some people won't take CCA, right? Or some people will. Their expenses, if you're in the GTA, right, like, and you're not cash flowing, sometimes your revenue might be just slightly higher than all your expenses because you have such a large mortgage, and your rents are usually your rent to purchase price ratio in the GTA is much lower than it is in Sudbury or Timmins or more cash flowing markets like that, right? Now, if you're holding that long-term rental in a corporation, right, that income is taxed at 50%. Now, mind you, some of that tax is recoverable when the corporation pays out dividends. It's a little bit out of scope for this conversation, but just keep in mind that some of it is recoverable. But the reason why it's taxed at 50% in a corporation is because it's passive income, right? So the government sees passive income as you're not putting in as much work, and so it's taxed heavier, right? And passive income is really anything that has to do with, like, rents, royalties, interest, or dividends. So in this case, we're talking about rents. Now, in a corporation, you can take your CCA and basically bring your income to zero, right? If you have enough building cost to depreciate and whatnot. But the long-term rental strategy for that reason, right, is really kind of I'm trying to aim to get out of the long-term rentals, right? Because right now 50% tax. Yes, you can take CCA and whatnot, but because my strategy wasn't from the outset built around cash flowing properties and the BRRRR strategy, and I wasn't really educated on all those strategies at the beginning when I first started. Now I'm looking to do a little bit more of those, but a lot of the properties I had bought were pre-construction properties. And so because I started to realize that, okay, I have a lot of equity gains in these properties. I can either liquidate these gains right now and then reinvest them into longer term rentals in better cash flowing markets. But some of these properties I find they're a little bit unique. If they're in good locations and they're brand new, I started to realize, okay, you know what? These are suitable for Airbnb. And so most newer investors who own properties that they renovate and they don't want to deal with long-term tenants sometimes get an Airbnb property management company to come in and furnish their property and run Airbnb, and either they just pay some long-term rent or they do a revenue share program, right, where the Airbnb property manager takes a percentage. And so you have to remember now, when you go from long-term rental to Airbnb is considered active income. So that's huge because you're now considered active. Because why is it active income? Because you're managing guests, you're managing maintenance, you're putting in more work. It's not really as
essentially you're running a hotel.
Exactly. So it's now considered active income. So now imagine.
Sorry, I think you meant it's not considered passive income.
It's not considered passive income, but it's active income.
Yes.
And active income, if you're a resident corporation in Canada, like a CCPC, Canadian Controlled Private Corporation, and you are eligible for the small business deduction, you can get away with paying just 12.5% on active income.
Right? Okay,
right?
Okay.
So imagine paying 12.5%, not dealing with long-term tenants. Mind you, you're more heavily involved in the business, right?
Yes.
Like the business is a lot more than just giving keys to a tenant.
A little bit more risk as well.
A little bit more risk, right? But with Airbnb, the tax advantage is huge, right? So all your furniture, again, is going to be CCA. And you can write off all that stuff against the income you're making on Airbnb. And it's 12.5%, right? In a corporation, you don't need to pull it all out. And if you have a holding company above this Airbnb management company that's making all this revenue, you can pay an intercompany dividend up tax-free. And then your holding company, with the money that's only been taxed 12.5%, can then go out and buy a 5-plex or a 6-plex or buy any other real estate by putting, let's just say if it's commercially financed, like 25% down with those profits that have only been taxed at 12.5%, right? So with that in mind, I've kind of now switched up my strategy to taking a lot of these. Don't get me wrong, I have liquidated one or two of those pre-construction properties to become less leveraged because of the nature of the market and the conditions in the market right now and rising interest rates and so on and so forth. And because the market had gone on such a run, I luckily hit the peak on one of those properties when I sold.
Amazing.
But the other properties that I kind of want to keep in the portfolio for a longer term, that are new, that I don't want to sell because they're either really unique or I think they'll do well on Airbnb. I'm switching up the strategy and now trying to run them on Airbnb. So remember, Airbnb, so these are not like, properties like condos, right? Like I personally think you want to have a detached property, at least for Airbnb. You want to be in a good location, right? So on and so forth. So I'm taking these newer properties, converting them from long-term rentals into Airbnbs. From there, right now, I just started a new company. We just formed a company. We're basically doing Airbnb management. And so there's going to be a Airbnb active company that's going to be managing all those properties. And eventually, once we get to super host status, the goal would be to then take a lot of these other properties that have been renovated, that other investors have, that would do well on Airbnb, and manage those properties as well. What if you can have an investment property and you lease it out to me at $2,500 a month, which is your monthly market rent, and I think it's an eligible candidate to do well on Airbnb? I'll commit to you saying, okay, let's sign a lease for $2,500 a month, and with $2,500 a month, let's then take that. Sorry. Let me rewind again. So Vino, going back to your earlier point about, what if I don't want to deal with long-term tenants or deal with the potential of non-paying tenants, right? I could look at you and say, hey, you know what? That property will do well on Airbnb. I'll pay you the $2,500 a month, which is all you want. You just want to make sure you get your rent. Yeah. And all my proposition to you is going to be, well, what if nobody's going to take that care of that property better than me, because every 2 to 3 days or every week that the guest is checking out, I'm having a cleaner come in there. You're
doing a full inspection on it. You know what's going on in the property.
We know what's going on in the property, right? And I'm giving you the assurance that you're going to get $2,500 every month too, right? And I'm more reliable maybe than any other tenant if I have a portfolio that's doing that, right? So obviously I'm not getting to that level yet, but
that's a goal for sure.
That's the goal for sure.
That's very smart, man.
So
that's crazy.
So it's kind of like, okay,
so you're essentially doing Airbnb arbitrage.
Well, the case I just gave is Airbnb arbitrage, but with my own properties, it's, I guess,
with your own properties, it's not really arbitrage.
Yeah, it's not really arbitrage, but it's arbitrage when you're doing it with other people's properties, right?
Yeah. OPP.
OPP, not OPM. But so there, you're kind of getting the advantages of tax because you're getting taxed at 12.5%. You're not dealing with long-term tenants and potential of non-payment of rent, right? You are taking on a little bit more risk because you don't know who's coming into your property. But at the same time, Airbnb, you can vet who's booking your properties, right? You can look at the reviews that they have. Again, like there's going to be people who fall through the cracks and throw a party in your Airbnb and here and there, right? Like risk reward, right? Again.
But the beautiful thing about Airbnb, because it's more of a short-term strategy, like just say you do get a shitty tenant that comes in or a shitty person who books it, you're not stuck with them for the next year or next 6 months or 1 year. They're out when they're out.
Now, as long as it's under a month, I know there's some gray area where if they stay past a month, then they could be construed as a month-to-month tenancy.
They go to month-to-month.
There is some gray area there, which I don't know the exact rules, so I won't comment on it. But let's just say you have a 7-day rent, 7-day short-term stay, and the person's there the 8th or the 9th day. You can call the cops and it's trespassing. Right, you can call the police and it's trespassing, right? It's not like you need to go through the landlord
board and all that stuff.
You need to go to the sheriff and all that.
You don't need to go through the landlord and tenant board because the landlord and tenant board is for landlord and tenant.
It's a whole big process.
When the relationship is landlord and tenant, this is not landlord and tenant. This is more so.
This is a
short-term stay. It's a short-term stay.
Stay. So you can call it trespassing and you can call the police and have them out of there, right?
Wow.
So
okay.
There's certain
There's
benefits
a
to
lot
it.
of pros, man.
There's a lot of pros to
And
it,
you
I
have the
think,
potential to make so much more income in that 1 month versus
Exactly.
Exactly.
So going back to pre-construction, what areas have you invested in pre-construction, and also tell me about some of your success stories that you've had with pre-con, because
Sure.
I know you have a bunch.
Sure. So my tax auditor role was in Hamilton the first year out of uni. So I was driving in Hamilton trying to figure out what the city was about.
Where the prime real estate opportunities were. Right?
Where the prime real estate opportunities were. So
all the pie-shaped lots.
all the pie-shaped lots. This guy was talking about my pie-shaped lot.
I know.
All day
Last
yesterday.
night. Oh my god.
So I'm dying at that. I didn't know much about Hamilton actually, so I was just after work. I'd drive around. I'd see, starting now, towns from the 400s, right? You see all those signs back then for pre-con. So I just sign up on all these builder lists, right? And then when the condo closed in 2018, I took a line of credit out and I was eager to put down on some properties, right? So I was like thinking, okay, you know what? And again, my investment knowledge at this point is very rudimentary, right? I didn't know anything about BRRRR or long-term investing, which I think, at that time, if you had done it, the timelines were quicker, because here I'm waiting 2 years for a property to finish, right?
Yeah.
So anyways, the thing I found the most attractive was the low deposits. So I would find the projects with builders that had low deposits. So like where I can buy a property for like $450 and put just $50,000 down or $26,000 down. So
were
give you an interesting one.
Were all those builders like reputable or
reputable? Very.
Did you make sure? Yeah.
So in Hamilton, I was looking at the biggest builders in Hamilton, which are Lozani and Mars Homes. There's a couple really reputable, good builders over there. Brandhaven, right? So the first two I put down on was Mars Homes and Lozani Homes. So Mars needed $50,000 over 5 months, and Lozani was like $26,000 over 6 months.
Wow.
So there was one town that I scooped up for like $435,000, and believe it or not, the deposit I had to put down was $26,000. So I put $26,000 down over 6 months, all from the line of credit.
Damn, son, where'd you find this?
No,
That's like an ad lib. That's like an ad lib.
I was on all like all these builders were emailing, right?
Yeah.
And as soon as I saw that it was $26,000, they usually have like a family friends round, then a VIP round, then the general public, and on this VIP round, it was a low deposit, $26,000. So, anyways, in my head,
sorry to get it. How do you get onto the VIP list?
Yeah, that's a great question.
You just got to sign up quick. It was all about signing up quick and getting there, being the first in line, whatever have you, right? So there were stories where me and my buddy would camp out all night just to get in the line.
This is the lineup pre-construction.
The lineup pre-construction before COVID.
I'm glad you lined up for pre-construction instead of lining up for like a PS3 or something.
Exactly. And then taken 3 days later, they only released 10 detached homes, and we're 11th in line, so we didn't even get one, right?
Wow. Okay.
So there were times I'll give you the good pre-con and the bad pre-con opportunities too. So, anyways, that town that was 435 ended up like in February, the peak, it was at 900,000. I mean, now it's probably worth like maybe 800, but still, like you're looking at about a $400,000 gain off of what spun off as a $26,000 deposit started off as, right? Mind you, if you have to close with 20% down, then you bring the rest of the money. But the way I kind of looked at it was, if I can put down $50,000 on this property, and in 2 years, if it goes up by 50,000 before I have to bring the rest down. Remember, mind you, this is unrealized. Like, you don't own it yet until you take title, right? So I'm just speaking in terms of like unrealized gain.
Yeah.
If it goes up by 100,000 and you end up taking title and you end up owning it, I kind of looked at it as, okay, I put 50, I made 100. That's enough for me, right? So that was the basic parameters I was kind of using to invest in at that time, right? So that was a really good one. And then there was a project in Kingston where Sage, which if you went to university in Waterloo, you knew they were at like Sage 10 in Waterloo at this time, right? So they were on the 10th building of student luxury rental. So that was the segment of real estate that this builder was specialized in. So when they went to Kingston, all the housing supply there for students is pretty it's very low quality housing. So they wanted to bring a luxury. So this was the first building of its kind. This was Sage 1 in Kingston, put it that way, right?
Yeah.
So I was like, this is a no-brainer. I saw this happen in Waterloo for 4 years. Like, this is going to be a great building.
Okay.
Every student who has money and whose parents are willing to pay premium for their luxury rental while they're studying is going to want to rent from me if I own a unit in this building.
Yeah.
So I bought a unit. A couple of friends bought a unit. My dad bought a unit. Now, this is where, the risks of pre-con come in. I bought the unit for $230,000, 1 bed, 1 bath, parking. It was just no-brainer pricing, right? And so I bought it, and then a year and a half later goes by. And mind you, what was really attractive about this property is because a lot of the land around Queen's University and Kingston in general is heritage protected. So you can't just tear it down and rebuild it, right? So the fact that they were able to get a permit for a building close to Queens was huge. That was number one. Number two was the fact that it was like the first ever luxury student building of its kind, right? So a year and a half passes by. They obviously, as you know, builders don't sell all their inventory all up front pre-construction, right? Like they hold a few units to sell in phases. Or they sold some units sometimes to sell at closing, right? So a year and a half later, they release more units, and they're $150,000 up in price that they're selling them for. And there's I get a notice from the builder that says, hey, your unit has changed in terms of like what was, has had some minor changes. We're going to refund your deposit and we're going to cancel the agreement of purchase and sale. So I was like, what? Like, are you kidding me? I just, put down like this money. I was so excited thinking, oh, I'm up 100,000, 150,000. Like, I just got to wait to close this and I'm sure it'll be higher. And no, like the builder basically said, like, we're going to cancel. And what happened. I don't know if this actually, transpired, but their argument to me was that there was a step back requirement during their finalizations with the permit on the building. The step back requirement involved them moving the building back from the sidewalk a certain amount. And apparently my unit was on the front of that building and had to be altered in order to satisfy that requirement. So they kind of used that as a way to get out of the agreement with me to sell the unit for $150,000 higher to somebody else.
Okay.
Right? So it happens, right? Like pre-con is risky. That's the one thing I want to put out there, right?
The builders have the power, right?
But mind you still get your deposit back. The only downfall is that your deposit didn't collect any interest.
They were a reputable, exactly, because the interest rates were low enough that deposits were not required to have interest paid on by the builders. I got my deposit back because it was a reputable builder. Again, it was a reputable builder at the end of the day, so they didn't take my deposit. I've heard of projects where they get canceled and the deposits are not returned, or delayed, for a while before they're returned. Wow. Right? I got mine right away. Amazing. Back. Okay. And so I took it, and then I was like, you know what? I have to, my whole thing was recycle the money. Never hold cash, because cash is trash, right? So in the sense of inflation is running up, I want to invest this somewhere else. So that first condo, I got on the board of directors at the condo because I was really eager to learn more about real estate and how does the condo operate and whatnot. And so in the first 2 years of when a condo closes, you'll normally see that the builder manages the property because they want to. There's, I think, an incentive, and also
they want to know what the building is. They want to create the systems, and then once they have the system set up, then they hire a third-party property management team, and then they kind of transfer everything over to them. So
you're right. The builder does, to an extent, manage the property for the first 2 years, which is kind of like a stabilization period, right? Like after it's built, whatever kinks they need to work out with the building, they work out, and then later on they move on from the building, and a third-party property manager takes over. So in the first 2 years on the board, though, I got to know the builder. And then the builder, by the way, this condo was an amazing condo. It was Green Life condos. So I don't know if some people know.
I've seen,
in Markham.
Usually the maintenance fees are super cheap. Right?
Markham and 14th, there's a condo. Kennedy and 14th, they have a build. So they're solar paneled buildings. So the electricity is solar for the common elements. There's geothermal heating and cooling. And there's ICF. So what do you?
I believe they also collect rainwater or something too, right? To water the.
So that was the commercial building, commercial building that I bought into. So we'll get into that now. So the builder that I met tells me that, hey, I'm building a commercial building at Markham and 16th. Sorry, 4 and 16th. Why don't you talk to my inside sales rep, Mitch? I was like thinking, you know what? Maybe owning a small office down the line will be good. Worst case, it'll be my swim school salespeople's office, or it'll be a real estate office, or it'll be an accountant's office, right? I was just dabbling in so many things.
Yeah.
At that point, and then until I fully got into real estate full time and tax, but. At that point, I was like, I want to deploy the money. So I ended up buying the smallest unit there. It was about 663 square feet. And for those who don't know, commercial pre-con actually comes in as a shell unit. So they give you the base building in a shell. Your unit comes as a shell. You get, your electrical panel, your HVAC system, and base building sprinklers, right? And then after that, you apply to the city with your permit and your drawings based on how you want to design the space for your business, right? That's kind of the whole thing about commercial pre-con. So it was a low deposit, right? So I basically took that deposit, put it down there, and the plan was to use the swim school income to finance the mortgage on the commercial property, right? So fast forward later, and the builder was really nice. He gave me, a small discount. Any of my commissions that I was going to earn on the unit, I deducted, because again, rather than having it, so tax tip, rather than having the income paid out to me and being taxed on, I just had it deducted off the cost of the property, right?
Okay.
Yeah.
Rather than it coming to me and being
you
taxed.
pay tax, yeah.
So I ended up buying that property for about $243,000, right? Shell unit. Spent about $85,000 building it out, and then there was about $10,000 in interest costs because I took some private money. And the reason why is because the swim school got shut down as this property got closed, right? So that's where I'm saying, like, you have a plan, but you got to be ready to react with or have a backup plan to close. So I ended up selling the first condo because there was a considerable gain, and I had lived in the condo for 2 years. And so it was eligible for the principal residence exemption, which is a tax rule that essentially says that if you occupy the place of residence as your principal residence, which means you ordinarily inhabit the property, and there's a few criteria. If you meet that criteria, the gain on sale is tax-free. So I wanted to, rather than continue to rent that rental property and have that sizable gain split up over more number of years, where it would have a change in use and become a rental property, and that gain would eventually be taxed when I sell it. I just thought, you know what, it's up about $250K. I can sell it now and pay no tax on that capital gain and move on. So for two reasons, it was good. One, I hadn't paid no tax on the capital gain, and two, I was able to take about a decent amount of that cash to close on the shell unit. I took some other private capital as well to close on it. Built it out, using the Home Depot credit card and whatnot, 0% interest. Built it out, took lines, built it all out. Again, I had no financing for this. I just did it in cash. My goal was to turn around the build in about 4 months. We turned it around in about 5.5 months after, like, from applying to the permit to closing the permit, inspections approved, everything else, right? So that was a good learning process, right? I got a contractor to do the parts that were, involved the permit, and then I even sourced some supplies, and it was a good learning process to, like, understand the build out and the permit process, right? So once the office was built, so at this point I transitioned into real estate full time, and so, like, I was like, perfect, we'll use this for the brokerage office, right? So I mean, before that, Mitch, who was the commercial rep who sold me that office, ended up becoming my commercial partner for the brokerage.
Damn.
So that brokerage, Grandview Realty, it's just for the listeners, the brokerage was really something that I know a lot of people say that, you want to get a decent amount of years of experience under your belt before starting a brokerage. But the goal was not to, have 50 agents or anything like that. We just kind of wanted to be a boutique brokerage where Mitch was covering all the commercial sales and I was covering all the residential side. And it was essentially what we've done is kind of built a brokerage focused on, novice investors and first-time home buyers, and helping them navigate the real estate market in a tax-efficient way, right? So that's what I like to focus on with my buyers and sellers, right? Because I think this is an aspect of real estate that gets overlooked a lot, right? Like, because think about it, like, when you're buying a property, right, you get your mortgage broker involved, you get your lawyer involved, you get yourself involved, right? Yeah. And you buy the property, but maybe you could have, maybe you could have pulled out $30,000 from your RSP for your first time home buyer on your first time home, if you had spoken to your accountant too, right?
Yeah. So it's like a full service.
So it's a full service, exactly. Our whole thing is, all the services under one roof. So now that's from the buying perspective. Now imagine you're selling, right? Your realtor tells you, okay, you want to sell your property because you're going through a divorce, right? Well, usually, taxes happen and this year's taxes are filed next year, and nobody really thinks about it. They sit down with their accountant and they tell their accountant, well, hey, I sold my rental property last year. When then your accountant tells you, well, you're going to have to pay this much tax, right? But if you had that consultation at the time you were deciding which property to liquidate, you could have maybe figured out, okay, which one should I liquidate that will still get me the funds I need, and
while saving you the most amount of money,
saving you the most amount of tax, right? So like, what's the strategy to go about that from a tax perspective, but not just the selling perspective, right? Because selling the property, closing the property, that's easy, right? But at the end of the day, when you have to pay tax on it, not everyone likes that and is ready for that. So you want to get your accountant involved in your situation, and that's why I'm saying, all this stuff I'm saying is for information, but everyone's situation is different, and you got to get your power team, right? Which, when you're in real estate, is your realtor, your accountant, your mortgage broker, your lawyer. In my opinion, the accountant is an important one, right? So that's my advice. Just give your accountant a call. Say, listen, this is what I'm gonna do with my assets or my real estate. What is gonna be my tax liability, and how do I reduce that? And so that's what we focus on at Grandview Realty. We focus on, number one, teaching the strategies to novice investors about their options when it comes to investing in real estate, and then number two, what their tax obligations are, but also the ways to save tax or go about it in the most tax efficient manner, right? So tax planning, tax consulting, that's what I do as part of the real estate sale. So
what are some of like the common questions you get from your first time home buyer clients?
So some of them are saying to me, okay, well, Terrence, like, what are the some of them don't really bring it up because they don't really know. So I'm the one to kind of bring it up and say, hey, is this your first property? So some of them might have like, let's just say your fiancés, right? And you want to buy your first property. Well, if both of you are able to buy your own property on your own, I would advise them, hey, you know what? Why don't you buy your property on your own right now, and then you go buy, your partner goes and buys her property on her own, and then you guys get married. So then that way you get the land transfer tax credit for each of you on both of those properties. Whereas if you get married, your land transfer tax becomes only one land transfer tax credit. That merges, right? So you can only get the benefit on one property. But if you both use that up individually before you get married on your own properties, when you get married, you'll have at least exhausted that credit, right? So that's a tax advantage that most people might not know of, and then how to maximize it with their partner. Another one might be your RSP, right? If you contribute to your RSP and have those funds in there 90 days before closing, you can use those as part of a down payment on your home and pull them out of your RSP without penalty. Mind you, you need to recontribute that over the next 15 years. And you get a break on the first year after closing, right? So you don't have to recontribute anything back in the first year, but after that, you've got to do at least equal amounts over the next 15 years to pay it all back into your RSP. But it's huge, right? Because not only are you getting a tax deduction off of your income, which is how you get the resulting tax refund, right? Because let's just say you had $60,000 in income, and you paid, just to keep it simple, $6,000 in taxes, right? If you deduct $10,000 of that and you contribute to your RSP in the year before you buy your home, let's just assume that you get $1,000 in tax refund. You can use that tax refund to increase your down payment, and usually it's more than $1,000, right? It could be anywhere from $6,000 to $7,000 depending on your tax bracket, right? So that can also help boost your down payment, right? Which is hard for many people to do, right? Not just the amount of money you're pulling out of your RSP, but also the resulting tax refund that comes from that, right? So there's a deduction there, and then what else, right? And then sometimes people are again buying it for investment. So I educate them on what expenses you can write off and how to go about filing the tax return at the end of the year for your rental property, right? If it is a rental property. And then what if this is your 6th rental property? Should you be incorporating, or should you consider a corporation to hold your properties in, right? Like, at what point in time does that come in handy, right? So these are all questions, like, we can get into it for hours.
Yeah,
right? But
yeah.
hopefully these are the most common ones, like for buyers.
So these are also like unique ways that you kind of service your clients outside of the standard realtor, right?
Exactly.
So,
that's really the competitive advantage, right? So I've kind of figured out how to leverage the CPA aspect of the designation, as well as the education that comes with that, and real estate, because I think they're pretty complementary, and that like I said, like it should be one of your members on your power team. Like, you should be considering your tax implications and obligations whenever you're buying and selling. Yeah. And at the same time,
because that's how you build wealth, right?
Yeah, exactly. 100%. Like, building wealth, like the richest people, that's why you always keep, right? That's it's whatever like everything that you're saving on tax, right, can be reinvested, right?
Exactly.
So you can be reinvested back into more swimming classes. You know, learn how to do. While you're doing like a backstroke, he's also teaching you how to legally save on your taxes, right?
Well, we're out of the swim business now, but yeah, the time value of money. The time value of money nowadays is so. Actually, when COVID came back, people were asking, you know, whether we're going to revive it or not. But unfortunately, that business, you know, it took a real hit. You know, we were because we kept being optimistic about the fact that things might reopen, and so. I was eating costs on keeping the database running and paying for other things and thinking we're going to open and then shutting down and opening and shutting down. And so that business kind of took its toll over the 2 years. And so it didn't really, one, make sense to revive, and two, it was pretty much kind of I've moved on.
You've moved on from that part. Yeah.
But if I can make a special request, if you can actually reschedule our tax consultation while you're teaching me how to swim as well. I'm not the strongest swimmer, so I was wondering if you can bring that back.
We can talk tax.
We'll talk off camera on that. Yeah.
Exactly. So
all right. So being a new agent and all, you know, naturally a new agent will want to join a team, or they want to go to a brokerage that offers a lot of support. For you to completely like disregard that and just go in and just go start a brand new brokerage. What inspired you to do that, and where did you look for guidance, and what were you kind of falling back on?
So I did join a brokerage to start off, and then I did transition to going full time on my own, and I think a huge part of that is having a mentor. So I do have a mentor, and whenever I had to fall back on that, that's where I fell back to. And so I think that was number one. And then number two, it was really just getting your hands and feet wet, right? Like, you're just getting out there, getting deals done, and going through experiences, you know, having deals go sour, or having to be flexible with certain deals, right? There was a deal I did where I was close to double ending the deal. And then my seller for this condo, I had bought him a pre-construction home that was going to close in December. And he was like telling me, Terrence, it's March. I don't want to sell 9 months early and then pay $2,000 a month in rent, even though this is a good price. So then I thought to myself, I'm like, okay, you know what? Like, how am I going to make this work? Because I do want my buyer and my seller to technically both be happy. And if my buyer can have this property and my seller can also find a way to sell at a price that he wants to, but figuring out his living situation in the interim at a lower cost could basically bring the deal together. So what I ended up proposing, I said to him, listen, my basement's unfinished. If you give me a $60,000 loan off of your line of credit at 2% or 2.45 at that time, you're going to only pay $150 a month on that cost of capital. That's your cost. That's the cost of your capital, $150. Loan me the $60,000. I'll finish my basement and I'll rent it out to you for $750 a month instead of the market rent of like $1,400 or $1,500 a month. So let's consider the $750, that discount I'm giving you, as the total as loaning me the $60K at 12%, for example, right? But you're only paying 2.45%. So your true cost is $750 plus your cost of capital, which is $900. So it's cost you $900 a month to live temporarily in my finished basement. until your home is ready. And for me, that's $900 that I was never going to see because I didn't have the $60,000 in capital to build out my basement to make that income anyway. So for the next 6 months.
And the craziest thing is that once you build your basement, it's just built.
It's built, and when he leaves, I can charge market rent.
There you go.
Yeah.
And it gave me the time to earn the $60,000 because I got into real estate, right?
And just for context, this is a pie-shaped lot in Pickering,
the
ravine
basement.
lot, walkout basement,
Yes.
fully renovated, like all
Two
new
bed, two bath,
appliances.
yeah.
It's
Stainless steel appliances. I told him I was going to do it up to the 9s for you. And the reason why I also did it up to the 9s was because the goal was to Airbnb that down the line, and now that's going to be one of the units that we convert as well once he leaves. But
This episode is going to be called Pie Shaped Lot, eh? No, I'm joking.
yeah. So
this episode is sponsored by Terrence's pie-shaped lot, right?
yeah, I know, man. Once the Airbnb makes money, then we can actually sponsor it. But so anyway, so then that's just like that's one example of making a deal work, right? So in real estate, I think we're really matchmakers, right? Like we're trying to make our sellers and our buyers happy, and we want to do it in a
creative way.
In a creative way. That's really
win-win
what it is. It's
situation,
really
right?
like the art of the deal, right? So in that situation, right, I was able to still get my buyer to buy his condo. The seller was happy at the sale price. He's happy because he's paying less rent until his home is ready, and he also gets the funds ahead of time, so he knows he's going to be ready for closing and whatnot, right? He really treasured that aspect of the security of selling now, because he also didn't know what was going to happen in the market, right? So he was happy to sell at a good time and walk away with the proceeds.
Awesome.
So, got some rapid fire tax questions for you.
Sure.
You wanna
Yeah,
answer
let's
them?
do it. Let's do it.
Typical questions. Maybe a lot of people out there probably have these questions.
Sure.
And it's better hearing it from a CPA,
Sure, why not? Let's
Okay.
go for it.
So say you're starting a business. When do you need a GST, HST account?
Sure. So depending on the industry you're in, right? Because GST, irrespective of the industry, let's just say once you start making $30,000 worth of sales of taxable supply. So that means you're in an industry where you're selling a good or service that has or that mandates HST, meaning HST is applicable on the sale of that good or service. Okay, so if you're a lawyer, you're charging HST. If you're an accountant, you're charging HST on your services. If you're a doctor, you're not charging HST, right? If you're selling medical glasses, you're not charging HST, right? So there are
What if you have like an
categories.
Amazon business, like an online Amazon business? That still
It depends
subject
on
to
what you're
HST?
selling.
Okay.
Depends on what you're selling, right?
Okay.
So I just gave some examples of what's HST applicable and what's not.
Yeah.
If you're selling what is and you're surpassing $30,000 in taxable sales, then you need to register for HST, right?
Okay.
And
What if? So what is? How do you go about reporting your tax if you don't surpass 30,000?
if you don't surpass 30,000, then you also don't get the other side of the equation, which is the input tax credit. So input tax credits are what you get to claim when you buy those supplies or you incur any costs and services that you pay HST on to supply that good or service. So let me give you an example. If I'm selling, let's say, toboggans, and I'm buying the toboggans from a supplier for $10, I'm paying them $1.30 in HST, right? $10 plus tax is $11.30. $1.30 of that is HST. Mm-hmm. But I'm selling them for $20, so I'm collecting $2.60 from my customer.
Yes.
So when you have an HST number, you have to remit $2.60 to the government, but the government allows you to claim the $1.30 that you paid when you originally bought the toboggan. So your net payable to the CRA is only $1.30. Does that make sense?
Yes.
So that's how it kind of all works, the full equation. So if you don't hit 30,000, you just don't charge your customers HST, but you also don't get the input tax credit, right?
Yeah.
So there are certain suppliers. So if you're a taxable supplier, so you're selling goods that are taxable, then you're collecting HST and you're claiming the input tax credit, right?
Yeah.
If you're in an industry where it's exempt, meaning the sale of your good or service is exempt from HST, you don't collect HST even if you pass 30,000 and you don't get the input tax credit. And then there are suppliers or businesses that qualify under the 0 rated context, which is where you don't collect HST, but you can claim the input tax credit on anything you buy. So that's the most lucrative one, right? Because you're not collecting HST, but you're always claiming the ITC, so you're always in a refund position when it comes to the CRA.
What's in it? One example?
I'm pretty sure optometrists, when they sell glasses, those glasses are 0 rated. So when they buy the glasses from the supplier, they pay HST. When they buy the glasses from the supplier, they pay HST. But when they sell them to the patient, they don't have to collect HST. So that could be an example of a 0 rated supplier, right?
Okay. So you just so for anyone under 30,000, you're just reporting it as business income. No, you don't register.
You're just not charging HST.
Yeah.
You could, if you wanted to get started early though. Like you don't want to wait till 30,000 and you're selling goods that are taxable. You could register for HST and start charging HST and then start claiming the input tax credits. You can do that from day one. But the requirement is when you pass 30,000 in a consecutive 12-month period.
Okay.
Right. Any 12-month period.
Okay. And when is it advisable to incorporate your business? Say you're just starting out.
So there's a few things you want to consider when you're incorporating, right? I think most people will quickly run to the tax benefit. Yes, there's a tax benefit to incorporating. As I mentioned earlier, right? Like there's preferential treatment of active income at 12.5%, right? That can be if not pulled out of your corporation, you can pay the 12.5% and it'll sit in your corporation. But beyond just the tax benefits, right, where instead of taking all that income into your personal tax bracket and paying, at the highest marginal rate, you're keeping it in the corporation and only paying 12.5%. So that's the main tax benefit of owning a corporation without getting into it too crazy. But then there's also the liability aspect, right? So if you're running a business in an industry where there's potential or greater than average potential for lawsuits or exposed liability, you want to run in a corporation, or you run your business in a corporation, because your business is its own entity then. A corporation is its own entity then. It has its own tax return. It's recognized as its own entity. It can be sued and it can sue somebody else, right? And so that's another reason why you want to hold things in a corporation. Let me give an example. Banks will want you to hold your real estate. Let's just say if I'm running a storefront and I own the store and I'm also own the business. The bank will want me to create a separate holding company for the real estate and have a separate company for the business, because if the business gets sued, the property is creditor protected. It's protected from the liability of the business. So they can sue the business, but the property will be held in a separate corporation, right? So that's just to give you an example of the liability aspect of it, right? So there's various things you need to consider, those two being the main ones. And so if you make $60,000 in your business and you need all $60,000 to fund your lifestyle, well, nothing is being left in the corporation. So there's no point of you incorporating, right? If you need the money you're earning is funding your lifestyle at that rate, like you're burning it all, and you need it all, or you're investing some of it, so you don't want to invest in a corporation for whatever reason, and you want to invest it personally in your TFSA, for example, right? Then you have to pull the money out personally to be able to put it in your TFSA. So then it makes no sense to incorporate. But what if you're making $250,000 as a realtor, and now this is new for realtors too, right? Now you can have your own corporation. It's called a PREC, a personal real estate corporation. Before, all realtors, all their income was added to their personal bracket. So you can imagine if you made $1 million, after a certain point, you're paying 50% tax, right? Now, let's use realtors as a good example of that. If you're making $1 million as a realtor, you're not using $1 million to fund your lifestyle, right? Unless you're really lavish,
somewhere
like heaven. But if you're not, which is most realtors are not spending $1 million, and I mean, mind you, they're not making $1 million either. But let's just say the number one realtor in Pickering, for example, is making $1 million. $900,000 of that they don't need. They can keep it in their PREC now and only pay 12.5%. Well, sorry, it's up to $500,000 is the small business deduction, right? So let's just say they make $500K just to keep it simple, and they need $100K for their lifestyle. Well, they can keep $400,000 taxed at 12.5% in their corporation versus bringing that $400,000 into their personal income and paying 50% tax even at the highest marginal bracket.
Besides just like the 12% corporate tax, what's a benefit of keeping that $400,000 in the corporation? Like, wouldn't you rather send it to your personal and then use that money towards some sort of investments like stocks, crypto, or like real estate?
Yeah, you can invest in stocks, crypto, and in real estate even within your corporation, right? Which is kind of the beauty of it, right?
But it's a higher tax. It's a higher taxable event, no?
It's 50% tax on investment income, yes, but some of that is recoverable. Remember, I was saying earlier when you pay out dividends. But the idea is that, okay, let's just say you're paying 50% tax even on your additional income. If you pull that $50,000 out and you're already making $250K, you're paying 50% marginal rate on that. So let's just say you take 50,000 profit out and you're making $250. You're gonna pay 25,000 of that in tax and only have $25,000 now to invest, right? Versus that 50,000, if it pays 12.5%, think about how much more capital you now have to go back and invest, right? We can do the time value of money and the after-tax impact and all that stuff. But in general, right, you see where I'm going with this, right? Like if you're in a high tax bracket personally, it makes sense to keep it in the corp. And you don't even have to just invest it in things. If stocks or dividends are taxed higher, well then pay an intercompany dividend tax-free to your holding company, and then go and buy a 5-plex and a solid purpose-built 5-plex, and take that and go commercially finance, use that money that's only been paid 12.5% tax down on the property at 25% down, and hopefully it's a cash flowing property so it carries itself and qualifies on the mortgage side. And then whatever rental income you have, use your CCA to write it off against it. Now, as long as you're okay with the recapture down the line or not going to sell it anytime soon, then you'll pay zero in tax, and you only pay 12.5% on that. Only 12.5% tax on that income.
Alrighty, man. That was a wealth of knowledge that you just spat out. Like, I've learned so many things. I would have to rewatch this episode a couple times to really, really take it all in. Thank you so much. Is there anything you want to kind of leave us off with? Any last minute messages?
I think we covered a lot. We kind of jumped all over the place. So I apologize if it was a little mixy, but that really is a story. I kind of went from realizing that being an employee was not everything it was kind of meant to be. In school we're kind of taught and groomed to kind of be an employee when we get out, right? And so I think if you're kind of in a position right now where you're kind of thinking, I want to make that next step, I want to challenge myself and start a business, go for it. That would be my first and foremost advice. I think you're never too young to start a business. Through the episode, I think you probably know by now, there's a lot of tax advantages when you own a business. And the reason for that is because the tax system rewards risk, right? And so we have to induce the economy, and businesses have to hire employees. That's why they get more benefits and advantages, right? So if you're thinking about starting a business, think of the skills that you have that you can leverage, and look at the industry as a whole and see if there's potential there. And if you can, and you have a competitive advantage, go for it. That's kind of like, how we built Grandview Realty, right? It was based on the fact that, okay, we can do real estate. Everybody buys and sells homes, but we're going to do it differently. We're going to bring the accounting and tax equation and advisement into our real estate dealings with our clients, and integrate that service and cover all ends of the spectrum, right? That's why we have mortgage brokers, lawyers in our network, on top of now myself as the tax advisor, and agents that understand and identify when those conversations need to be had, and they're had with me. And so I enjoy thoroughly advising people on, the tax implications when it comes to real estate, and that's what I do. So if there's anything or anytime anybody has a question or wants to reach out to understand, where those two kind of cross sect or what their situation is, I'm more than happy to run through the situation and see how I can help from a tax perspective, as well as from a real estate perspective. And I think it's important to, if you're a novice investor, work with an investor focused realtor, someone who has experience dealing with investments and buying and selling, and also probably identifies an accountant as part of their power team, right?
All right, guys. So if you guys made it this far into the podcast, we appreciate you. Make sure you guys like, follow, subscribe. All of our Instagrams and links are in the description down below. And Terrence, how does anybody reach out to you?
So I'm on Instagram. It's Realtor Terrence, REALTOR Terrence, TERRENCE on Instagram. Soon we're starting a tax practice. I found that there's a lack of the tax knowledge and advisement on real estate out there. So I'm starting a small tax practice and equipping that with staff right now. So and going through the process of formalizing that. So if and when we'll have an Instagram handle there, but you'll see it on my Instagram page. So if you need anything accounting, tax related, and real estate related, feel free to reach out. And other than that, I appreciate you guys. Thanks for having me on the podcast. I had no idea I was just a second guest. Hope there was some nuggets that people can take away from and really use. And just remember, everyone's situation is different. I hope there was some good general knowledge to identify where you might be feeling you need advice, and get that from your professional accountant or realtor with respect to whatever field it is. And if that has to be me too, I'm more than happy to help.
Also, guys, a lot of the nuggets, we're going to be compressing them down into TikToks and Reels. So if you guys follow us on TikTok and Instagram, all the links are down below. You guys can actually rewatch all of his all the nuggets that he dropped on the podcast. Make sure you check him out as well. He's always dropping a bunch of knowledge on his pages. He does a lot of live seminars and stuff as well. But yeah, man, I appreciate you coming on the show. And
sure.
There's one thing that's possible. And what is that, bro? What's possible?
Wealth is possible, but also getting there quicker by doing it in a tax efficient way.
Making the right moves.
That's how the wealthy get wealthy. So
Exactly.
Also pie-shaped lots.
Tax.
Yeah, and pie-shaped lots. Yeah, and
Pie-shaped
also
lots.
shout out to Terrence's pie-shaped lot. We actually came here last night and came here for a tax consultation, but somehow ended up staying the night. And night got pretty hectic. But
we're recording on the pie-shaped lot.
On the pie-shaped lot. So shout out to the pie-shaped lot. We actually increased the equity of this home after this episode. But yeah. Appreciate you guys being here, and make sure you guys subscribe so you guys can watch all of our cool interviews that we have. We have a bunch of other like-minded individuals that are going to be popping on the channel.
Looking forward to seeing them.
And then until next time. All is possible. Take it easy. Peace.
Take it easy.
Take care.